we've talked a little bit about rates, which really can impact all asset classes, but let's narrow it down into equities right now. And specifically, we're going to move on to our next theme, which in the public domain anyways has been more aligned with equities, and that's AI. That's arguably had a much bigger impact on all of our personal and professional lives. Just as U.S. monetary policy has really diverged, we still see U.S. equity markets, again, continue to perform strongly, driven by investment in AI and amongst the hyperscalers. As we enter 2026, this appears to be shifting more so from investment. Again, we're talking about return on investment now, the focus on returns and recouping the spend. Where do you expect monetization to show up first? Christine, I'm going to bring this to you.
Sure. So last year, our theme was to look beyond the Mag 7. So this year, it's really an evolution of that theme to say, now it's not just about the Mag 7 or beyond the Mag 7. It's really about who within the AI core of the AI ecosphere, but also the peripheral part that's going to be able to generate an ROI. And also thinking about from a broader AI adoption perspective. So now not only just tech companies, but financial companies, are they applying AI in a way that allows them to increase their return on investment? So on this slide, what we're trying to show you is some of the current applications, and a lot of them are actually already showing up in our everyday lives. So agentic AI, right? So think about now when you're calling in or you're on a website and you need help. Now more so than ever, the odds are it's an agent, like it's some kind of chatbot that pops up. But unlike perhaps version 1.0, which is much more simplistic, this agent is more complex. And it feels a bit more like you're actually conversing with someone on the other side. And part of it is just the training and the complexity of the knowledge behind this AI agent, if you will. Then you've got things like generative design, generative sort of analysis. It's even on our team, we've really leveraged not necessarily AI, but just being able to analyze more quantities of data more efficiently, and more quickly. And you're now clearly starting to see a lot more application of AI in robotics, for example, going from precision manufacturing to robots that can perhaps think on the fly. So if there's a problem on the line, can these robotics actually respond? So in terms of kind of scaling and how quickly the ROI comes through, it depends. So agentic AI, anything that helps with optimizing operations, that's the first generation, and we're starting to see that already. So again, if you have call centers or if you have anything that faces the client, having an optimization using AI, that really flows to your bottom line. Some of the ways that you're seeing ROI already, if you look at some of the e-commerce retailers or even just bricks and mortar retailers that have a online presence, they're using AI to engage with you smarter. So now you'll notice when you click on a website, it'll say, hey, Baden, what about this? And there's more of a push, but it's a smarter kind of push. It's a push that clearly shows that something behind that is doing more work understanding what you've been recently buying and what you've been doing. So that's a big part of it. Of course, part of smarter engagement is also just companies analyzing and understanding client cycles. Like, are you a point in your life where you're thinking about certain purchases? So these are all ways that we're thinking about how companies can apply AI to increase their top line, to maybe broaden the type of products that they're able to sell to the same customer, hence enhancing their AI. On the other part is just more on the R&D side, faster innovation cycles. So we talked about digital environments. So imagine a world where, let's say, your pharma R&D, phase 1 used to be you just have to throw a bunch of different compounds to test which ones could fit before you take it to phase 2 and safety trials. What if you could create a digital environment and test that? Not only are you able to move faster, but it's more cost effective, and you really shorten the time frame of that initial phase, which typically is the noisiest and can be the most complex. So for us, it's really, we think this is the year when the rubber hits the road, as our team likes to say, and investors are going to be really focused on sort of thinking about how all of these investments are going to show up in terms of ROI. And it's really notable to highlight that the total CapEx on AI this year, coming off a stellar year in 2025, is expected to be higher. So over $600 billion is estimated for this year. That's tremendous. And because of that, after 3 years of hundreds of billions of dollars in investment. And we're now starting to say, okay, what's your monetization model and what does that ROI look like?
Thanks, Christine. Chad, I want to ask you a question here.
Yeah, sure.
We're going to turn it over to you. Many observers are drawing parallels now. I think it's we can't avoid this, I think, between the early 2000s tech bubble and what we're seeing in AI and tech valuations today. You and I talked a little bit about the circularity of capital, thinking back about Cisco and the early 2000s and how vendor spend really was pulled forward because of this demand that they had expected. We're somewhat seeing that today. Folks are concerned on the line, I'm sure. What are your comments about this phenomenon?
Yeah, no, I mean, Christine, probably her last thought kind of showed, as high as the spend was last year, it's expected to be even higher this year. Makes a lot of sense for people to start questioning, and even this overall theme of what's the return on that investment going to be. This is going to play out over a number of years now. Are we in a bubble today? I think is at the heart of the question. Perhaps not. Will this likely get to that point? I think anytime there's a new and such a disruptive technology, you are probably likely going to get to that, and there's going to be some winners and there's going to be some losers. So that's where there are similarities to the year 2000. I think we're earlier in the innings, so then closer to necessarily the end this year. But there's also often many differences, right? Like even in terms of the replacement cycle for that spend. I think one of the things with the internet, and you had companies like Cisco Systems, laying fiber optics in the ground. That was a long-term infrastructure build that didn't really need to be repeated. If you think about a lot of the data centers and the chips that the GPUs that go into the AI infrastructure, many of those only have kind of a 5-year lifespan before they become obsolete. So there's a CapEx cycle here that kind of continues. Now, no question, you need to see some value from that. And we're going to go through points this year where undoubtedly the market's going to be concerned about valuations, about the level of spending. There's going to be points of this year where exuberance takes over and we're more focused on just the sheer, kind of earnings power of some of these, the infrastructure players, the hyperscalers within the AI space. So there's going to be, I think, a lot of noise and questions around this. I think the biggest thing for investors to understand is you definitely want to participate in the AI theme. It's going to get frothy out there, but we're probably not at the end of that story, right? Yeah. We're somewhere in the middle of that. It's going to be very important to have managers that are positioning a portfolio, looking for the relative winners versus losers, and it's good that the market is starting to ask questions around, who's actually getting a return on investment here versus others, and that's what would actually make me believe that we're not really at a bubble peaking level, because that's usually where all of that sort of scrutiny and disbelief has washed away and people believe in some sort of completely new paradigm, right? So right now, I think that it's good that there's a lot of questions out there. It kind of goes back to that first question you took from the crowd as well. Like some of that uncertainty is actually quite positive for markets. That's the sort of wall of worry that the markets climb over time, right? So it's healthy to have some of that skepticism, but also important to know this is a new technology, very disruptive and a major kind of step forward. You're likely going to see tons of investment. You're going to see some overinvestment, and you need to buckle up and ride it out, right?
I like that you bring up healthy skepticism. You bring up winners and losers, and I have to talk about that for a second because if this doesn't pan out, what parts of the AI ecosystem would be the most vulnerable? Maybe Christine, I'm going to ask you this, if you can just maybe in a minute or so, let us know your thoughts.
Yeah, I think going back to Chad's point in terms of sort of capacity, if I can call it that, right now it feels like the main limitation is really we can't get enough compute power. And now there's a focus on how much inference power there is out there. But at some point, we're going to look back with the benefit of hindsight and realize we didn't need all that. But you only know that with hindsight. I think right now, one of the main concerns for policymakers, more so than investors, because for investors, we actually benefit from this, is what we show here on this chart, which is what impact does this have on employment? because what we've really seen coming out of the pandemic, and it's a confluence of factors. So CapEx has actually been spectacular. This is US data here, but in some ways you could say it's echoed across the world. Of course, strongest in the US because the hyperscalers are there. But what's different is this time it's a very employment-like CapEx. So historically, it's been more of an industrial type CapEx where you build a new factory. What do? You hire a bunch of people, build it. Then you hire a bunch of people to work in it. Now you're actually spending on compute power, data centers. And if anything, your clients are now able to leverage that AI to perhaps hire fewer people. So you keep hearing that term, low hire, no fire, right? So companies are not laying people off because the overall economy is kind of okay. But if you look at the unemployment rate for under 25 in Canada, for example, it's 14%. It's almost more than twice what the nationwide level is. So that's one potential loser that the policymakers are sort of focused on. And you kind of see that here in the US data. It's echoed in Canada.